Okay, good morning, everyone. My name is Paul Foreman, International Sales and Technical Manager here at Novia Global, and delighted to see so many registrants this month with our latest Pulse webinar. The topic this month is yet another of the pension planning acronyms. We've had SIP, we've had QNUPS, we've even had IORPS, and today we're going to be throwing QNUPS into the mix. I think that completes the set. So qualifying non-UK pension schemes. Delighted to be joined today by David White and John Clare from QB Partners, because QNUPS can be quite a technical and complex planning area of pensions. So great to have two experts with us today to run through some examples, because they've previously got their sleeves rolled up and worked on QNUPS with global IFAs for a number of years. So with some examples, they will run through the opportunities that might present themselves for you, both with your existing and potentially new clients. We anticipate the webinar will run for about 45 minutes this morning. And if you do have any questions or queries, there is a Q&A tab towards the bottom. If you post the questions on there, we'll ensure that they're dealt with at the end of the session. So without any further ado, I'll hand you over to David now. Thanks, David.
Yeah, thanks, Paul. Morning, everybody. As Paul said, I'm David White from QB Partners. I'm joined by two of my colleagues, John Clare, who's our pension specialist. He's going to answer all the difficult questions that you have at the end. And we've already had some questions sent through to Novia Global, which we'll try and incorporate as we go along. And we're also joined by Mike Foxall, who's the QB Partners Relationship Manager with Novia Global. I think Mike's just here to make sure that I don't mess anything up. So we'll crack on with the presentation. So just quickly, very briefly, just want to introduce QB Partners. Slides are moving a bit slowly, Steve, so if you could move that on. So yeah, we've been long established now since 2009, and what we do is provide technical support to IFAs, professional advisors, and to product providers. And we try and give this support in a very sort of practical way. So those of you who've worked with us will know how we work. We normally work with you to look at a specific client and their circumstances and objectives, and then help you find a solution for that client. Our background was in QNUPS. Some of you may know us as the QNUPS Bureau, which was the name we started with, focusing very much on that area, and then that obviously evolved into QNUPS and other forms of international pensions. So we've been doing this type of work for a long time. And then in 2017, we evolved the business to start covering other areas. And Mike Foxall, who I mentioned, his speciality is wealth insurance, the tax treatment of portfolio bonds, and that type of thing. We have 2 or 3 estate planning specialists, and then 2 or 3 pension specialists. So anything really that you might get involved in as advisors, other than investments, we can provide support with. Thanks, Steve. Just bring the next slide up. So yeah, this is the last slide about ourselves. We provide an independent service. So our background, a lot of the people within QB Partners are from Life Office technical departments, and we have to compare what we do with an independent version of a Life Office technical department. But as you know, when dealing with those guys, they're very good, but they will always say that they can't give you advice. We don't advise clients, but when we give you advice, it's in writing, often through a suitability report, and it's covered by our PI insurance. So we stand by the advice we give you, and it's completely independent. We're not tied to any service provider. We're not tied to any portfolio bond provider. We're not tied to any QNUPS provider. We're completely independent of the market. But because of what we do, we provide a lot of consultancy to providers, and that's how we work with Novia Global. So in working with Novia Global, you could actually get some access to our services through Novia Global. So if you've got any technical questions, then go to Paul and his team in the first place, and they'll answer. Paul's got a very strong technical background himself, and some of the rest of the team have. they'll answer the questions if they can, but if they can't, they'll refer on to us, and then we'll deal with your initial questions, and then we'll tell you how we can help you going forward on client-specific inquiries. We provide due diligence on any providers that we do recommend. There's full comprehensive due diligence. And what we say is that working with us helps your advisors engage with high net worth clients who've often got complex planning situations, but in a way which reduces the risk in your business because you're working with known experts in the area. So before we go on to the QNUPS presentation itself, we can bring the slide up, the introductory slide. But I just wanted to do a show of hands, really. If we were in a room, we'd take a show of hands as to a couple of questions. We can't do that. So what we've done is Steve at Novia Global has produced for us a very short poll, and it'll take less than a minute to answer these questions. So if you could all just answer those questions very quickly. It's not a test, it's just a few simple questions, and that'll give me some information which we can start to bring out during the presentation, hopefully. So just give you a minute to answer those questions, and then we'll get the results up and talk them through. Thank you. Okay, great, thanks. These are the results. Thanks for bringing those up, Steve. So we can see from the top question, there's broadly a 50-50 split in terms of people in the audience who've been involved in QNUPS in the past and those who haven't. So those of you who have, hopefully you'll recognise some of the planning that we start to talk about, and hopefully we can give you some sort of more pointers as to what you should consider in the planning, and we can provide ongoing support if you require it. And those of you who haven't advised on QNUPS at all, which is the slight majority, 52%, what we want to do is take you through this new area to you of planning, and hopefully you'll start to see that it might work for some of your clients. Loads of you, most of you, 95%, have got clients who haven't made adequate plans for their retirement. So this is where QNUPS, really comes into its own. It is, as the name suggests, a pension scheme. It should be used for retirement planning first and foremost. So that's how you would introduce it to your clients. And if your client, answers your question, if you made adequate plans for your retirement with a negative, they haven't, then that's a great lead into starting to discuss QNUPS, and that's the way it should be raised. And then there are tax planning advantages to it as well. Again, a sort of 50-50 split, a few don't knows, obviously, as to clients who've used up the UK lifetime allowance for pension provision. The UK lifetime allowance now, it's as you will know, it's reduced significantly over recent years, and it started to go up again in line with inflation, but this year it's been frozen. And it's just over £1 million, and £1 million, it sounds like loads of money, but that will provide, as we'll see in the case study later on, around about £50,000 per annum in retirement, which for a lot of your clients isn't going to be sufficient. So if you've got clients who have UK pensions, if they're overseas, they may not be able to increase their pensions through the UK pensions anyway. But even if they have got UK pensions and are allowed to increase them, if they're getting close to the lifetime allowance, then it's not tax efficient to do that. So QNUPS can provide supplementary pension planning. Again, most of you have UK domicile clients, as we would expect. So most of you are dealing with UK expatriates who will have a link to the UK and have a UK domicile. And the importance of that is that if they're UK domicile, they obviously have a UK IHT issue, and this type of planning can be very IHT efficient, as we'll see. And then again, lots of you have clients who may not realise that the UK domicile and have a UK IHT issue. Many clients who've been living overseas for a number of years start to think that they are a resident of the country in which they live, and therefore they don't have any connection back to the UK from a tax point of view. And as most of you will know, it's not that simple. And UK domicile is actually based primarily on where the individual's father was born. So even if somebody was born overseas, they may have UK domicile and they may have UK inheritance tax issues which they're not aware of. So we'll try and bring these points up as we go through the presentation, but I just thought it was worth covering off those initial questions before we started. So we're going to make a start now on the first slide, which is the background to QNUPS, a broad overview. It's been in place now since 2010. In 2010, there's a statutory instrument 51 for the tax geeks, which was brought in place to clarify the inheritance tax treatment of overseas pensions, QNUPS. And then, as Paul said, this new acronym of QNUPS was invented. And initially, there was some quite aggressive promotion of QNUPS. We were involved in the market at that time. We'd sort of QNUPS Bureau had been going a couple of years, but we held back from the market and took some tax advice because we felt it was being promoted very aggressively. And QNUPS was being promoted very aggressively as a tax planning vehicle, as an inheritance tax planning vehicle in particular. And as we'll see, there are some good tax advantages, but as we'll also see, the most important part of establishing a QNUPS is that it must be seen as legitimate pension planning, as legitimate retirement planning, and we'll talk through how that might be done. One of the ways in which that can be demonstrated is to use a genuine pension provider. So there are jurisdictions which have trusts which are badged as pensions, but they're not genuine pensions. And when we look at QNUPS planning, we look at the different jurisdictions. And we're based in the Isle of Man, but that's not the reason. I'll use Isle of Man as an example. And the reason that Isle of Man works very well for QNUPS is that the QNUPS providers are regulated by the FSA, Financial Services Authority in the Isle of Man, as pension providers. And the legislation, the rules are governed by the legislation. So the pension rules are governed by the legislation and by the tax office in the Isle of Man. So if HMRC, who brought QNUPS into the market in the inheritance tax legislation, were to challenge whether a QNUPS was a genuine pension plan, they'd have difficulty challenging one that was established in the Isle of Man because of those 2 points, that it's regulated as a pension plan and the provider is regulated as a pension provider. In 2017, some rules were brought in place by HMRC, which basically brought overseas pensions tax treatment very much in line with UK legislation. And that made some changes to QNUPS. And we have to bear those in mind as well when we're planning using QNUPS, but we'll talk about that in a bit more detail. We go on to the next slide, and that talks about some of the types of people who QNUPS are suitable for, the types of clients who QNUPS are suitable for. So when looking at this slide, think about your own clients, think about the type of clients that you've got, particularly those people who are coming into this area planning for the first time, which was around about 50% of you from the poll. You will all have clients, as we saw, who have a shortfall in pension planning. That was a very high percentage. And lots of you had clients who were fully funded in terms of the lifetime allowance as well. So they're going to be suitable. UK domicile clients in particular because of the advantageous tax treatment. But one of the questions that we had prior to the webinar was, can QNUPS be used for non-UK domiciles? And it can, and one of the advantages would be that anyone who has UK property or assets, whether or not the UK domicile, does have UK IHT issues and considerations. So QNUPS would be of an advantage to them. You'll all, as we saw, have lots of expatriates that you deal with, and lots of those people will be working overseas, but will be planning to return to the UK when they retire. And those people need to consider their retirement and how they plan for their retirement. And if you're earning overseas and you're accruing your savings overseas, then it doesn't make sense to put that into a UK pension vehicle. You're not able to use a UK pension vehicle when you're overseas anyway. And so it makes sense to accrue the pension in an overseas pension because you're working overseas, and that's where QNUPS can be a big advantage. High net worth or high earning clients, that's just a sort of guide really for the sort of clients to target for this type of work. It probably wouldn't be attractive to people who don't have money to invest or aren't earning and have disposable income. It doesn't have to be a lump sum contribution into QNUPS. You can fund it with regular contributions. So you can consider your clients who may not yet be considered high net worth, but have high earnings and need supplementary pension provision. And then the other advantage is it can be used to accept transfers from other overseas pensions. So we were looking at something yesterday where a client was in an overseas pension. A lot of you will come across the oil workers who have Bermuda pension plans. And when those clients move back to the UK, the first thought is to move the pension back into a UK pension. And we'd often say, well, don't do that because you're bringing your pension back into a UK pension, a UK tax net, with you. There's no reason why it needs to be in a UK tax net. The pension's being accrued overseas, so keep it overseas because that will be more tax advantageous when you become UK tax resident. Okay, next slide, please. We're able to put the next slide on? Must be stuck.
It's showing on the next slide, David.
Okay. Here we go. Sorry, my own presentation was stuck there for a minute. Apologies for that. Okay, benefits to the investor. The benefits to the investor are tax-free growth on the investment. So as well as the inheritance tax advantages, funds within the QNUPS benefit from gross roll-up. So they roll up within the QNUPS and any capital gains taxes is deferred. You can hold the plan in any currency. You can take a pension commencement lump sum from a QNUPS. There's often some debate on this, but from 55, a pension commencement lump sum can be taken. If the client has become a UK resident, then there are some restrictions on the tax-free lump sum, obviously, that can be taken. There's some detail around that regards the lifetime allowance that needs to be considered as well. If somebody is retiring overseas, then you still need to take into account the overseas tax treatment, the tax treatment in the country of residence. But QNUPS are very adaptable should members relocate from one country to another. So the personal pensions, they're portable. They do work with lots of different countries' tax jurisdictions. Lots of tax jurisdictions give advantage to overseas pension income, and the QNUPS will normally be an overseas pension to where the client is resident, so that can be tax advantageous. And the big tax advantage is the inheritance tax on there. Okay, next slide, thanks. Okay, so let's talk about the types of investments that QNUPS can hold. Paul and Steve will be pleased to know that international investment platforms is there. I think Paul would have kicked me if I'd not brought that up. So something like the Novia Global platform, other investment platforms are available, can be used very advantageously to hold the assets within the QNUPS. So the QNUPS is the tax wrapper, but you need something on which to hold the assets. And again, if you're looking at something which is an overseas pension and you're potentially transferring assets from the client's UK estate into an overseas pension, then it doesn't make sense to then invest the assets back into a UK cited investment manager or investment platform. So the Novia Global platform is custodianed in the Channel Islands, I believe, and that means that your assets are being held within the QNUPS, within an offshore environment, within a non-UK environment. There is flexibility in terms of other investments that can be held, as you can see from the slide. On property, there was a question pre-webinar, is it advisable for non-UK residents to put residential property into a QNUPS? And residential property can be held within a QNUPS, but as we say here, only on a commercial arm's length basis. So you can't hold your principal private residence within a QNUPS. Even if it is a holiday home, then the member can benefit from that. So that might not be seen as genuine pension provision, and the trustees may not allow that. But if, for example, somebody had a small portfolio of residential properties that was being leased out on a commercial basis, then that would be considered a suitable investment. Okay, next slide, thanks. Okay, so we're now moving on to the correct implementation of QNUPS. And I've said right from the beginning that for QNUPS to have the tax advantages, it has to be implemented correctly, and it has to be implemented in a way that it's seen as genuine pension provision. Otherwise, it might be seen as tax avoidance by HMRC. And in reality, HMRC may not be looking at the QNUPS from a tax perspective until after the member has passed away and they're reviewing the member's estate. But things here to consider are, you wouldn't use QNUPS for somebody who was elderly, and by that I mean perhaps sort of 75 plus, because the reason for pension provision starts to become less clear at that sort of age. And certainly, if you get sort of over 80, it could be considered as deathbed planning. So you have to be careful about the age of the client when you're considering QNUPS. You also have to be careful about the amount of the client's assets that are placed into the plan. I mentioned that when QNUPS was first introduced, there was some very aggressive planning, and that was basically, move all of your, people were recommending that clients moved all of their estate into a QNUPS because it took it out of their estate. It's got to be seen as genuine pension provision. And if the HMRC are looking at the client's assets and the client's estate post-death, then what you don't want to do as an advisor is have the family in a difficult position whereby they expected that these assets were outside of the estate, and suddenly they become under scrutiny from an inheritance tax point of view. So this implementation, the importance here is that there's a documented file as to why the QNUPS was implemented, and to show it was implemented as genuine pension provision. And that the assets are then pension assets, and they're bound by the rules of a retirement savings plan. So that means you can't take money back out whenever you want to. You can take benefits from age 55. but flexible drawdown isn't normally permitted from a QNUPS, because one of the rules of QNUPS in most regimes is that you have to use 70% of the assets to provide an income for life, and then the other up to 30% can be paid as a pension commencement lump sum. So those assets are pension assets and must be bound by the rules of a retirement savings plan or a pension. And that's why I said when we looked at Isle of Man as an example that, you know, the pension provider is a regulated pension provider, and the rules are pension rules. And then the other aspect that we look at in the next slide is what we call a funding gap analysis. And whenever we give support on QNUPS planning, we have this documented on every file, and it's quite a simple calculation. But basically, we have a discussion with the client's advisor as to what the client's current level of income is, and then what do they need, what do they think they're going to need in retirement. And some people use cash flow modelling for this to support this type of planning. But basically, you're looking at what the client needs in retirement. So they may be at this stage where they've paid off the mortgage, so they need less income than they had during their working life. But other considerations can come into play. They might want to do lots more travelling. They may have had a very high income in their working life, and they have a lifestyle that they want to maintain. They may wish to consider children's school fees, grandchildren's school fees, university fees for children and grandchildren as well. So there's other things which come into play, as you'll find when you're doing cash flow modelling, which start to determine the retirement income that the client needs. And there's a discussion with the client about what your current level of income is, and when you retire, what age you're going to retire at, and when you retire, what level of income do you think you need. And then we look at that level of income at the retirement age of the client, and a fund that's required to be invested at retirement to provide that level of income. And then we look at any other pension provision that the client already has and what income comes from that. And then that's where we get the funding gap. So the current level of pension income, you know, using our lifetime allowance example, 1 million provides £50,000 per annum in retirement, for example. But the client says, well, I want £100,000 per annum in retirement because I need to do this and that and the other, and I've been earning 150,000. And so the funding gap in terms of retirement income is 50,000. You then need to work out what level of fund needs to be invested or held at retirement to provide that level of income. And then we discount that back, we wind that back to the client's current age to say, right, what needs to be invested now to provide that fund at retirement. And that's the funding gap analysis. And if that is documented on the client's file to show a discussion was held with the client to look at what level of income they needed in retirement, and a discussion was held as to what level of fund would be needed at retirement to provide that, and what level of fund therefore needed to be invested now to provide that, then that's quite compelling in terms of genuine pension provision was being considered, and looks compelling on the client's file. One of the questions was, does that need to be done by an actuary, and leading on from that, do we need an actuarial report to determine an acceptable level of drawdown from the QNUPS? So that's a slightly different question. That's saying that for it to be pension provision, you need to take an income in retirement, and therefore you can't just save everything until the client dies and pass it on to benefit from the inheritance tax treatment. And normally we say that an income of 50% of GAD, which is the Government Actuarial Department guidelines, should be taken in retirement from a certain age. So it doesn't have to be from 55, it could be from 60 or 65. But at some point, the client needs to start taking a genuine retirement income. And that calculation could be done by an actuary. This funding gap analysis can be done by an actuary, and we actually do recommend that an actuarial report is produced, and we can facilitate that. But the calculation can be done by ourselves or by yourselves. So there's no compelling need. to have an actuary involved, but it helps the robustness of planning if an actuary has been involved, I guess is the answer to that question. Okay, we're now going to talk about a case study, which is based on a real client that we had. His name wasn't Richard Brown. He wasn't a commodities trader. He probably was about 58 and did intend to retire at 65. But this guy's got, he's already got some pension planning. He's got some UK SIPs. He's got some QNUPS. He's got some former employee schemes. And altogether, they're valued at around £1 million. Next slide, thanks. And the guy's lived in Asia since age 11. This is just some background information, not necessary for the QNUPS planning necessarily. He went to university at Oxford. But what is necessary is the father's British, he is UK domicile of origin, so we can see that QNUPS would be advantageous. And some of you had clients, lots of you had clients who were UK domicile of origin. Some of you had clients who didn't know. This client owns a residential property in the UK of 650,000. So whether or not he was UK domicile of origin, he'd had some UK IHC considerations. He's also got UK bank accounts, and he's got assets of circa 2.5 million. So if we look at the next slide, we start to see how QNUPS can be used to assist this client, to help this client. So he has a retirement objective following our discussion to earn £7,000 per month, £84,000 per annum in retirement. As we said, he's got about £1 million in his SIP currently, or in his pensions collectively currently. And as we were saying before, £1 million sounds like a lot of money, but for this client, we calculated that after PCLS, when he retires, it'll provide about £47,000 per annum in retirement. So we're going to look at funding the shortfall via QNUPS. And the difference between the £84,000, this is the funding gap analysis, and the £47,000 per annum is £37,000 per annum. And we've calculated, therefore, that an additional £725,000 fund is required at retirement to provide that shortfall of £37,000 per annum income in retirement. And we wind that back to his current age and work out that he needs to invest £585,000 today to fund that shortfall. So we can document that on file, and when that's reviewed, we can show that genuine pension provision has been considered, retirement objectives have been considered, and a calculation was made to support that. And on the next slide, we'll see the advantages of that. So the QNUPS has provided the tax efficient structure. He will have gross roll up within the QNUPS, capital gains will be deferred. And he's going to make a saving in this example of 234,000 on that contribution that he makes to QNUPS. That's immediately outside of his estate, and the fund doesn't suffer UKHT. If he becomes UK resident again, there are considerations on the tax treatment on death. There is income tax on death. So that does need to be considered if the client becomes UK resident again. But if the client stays outside the UK, then the investment's gone outside of his estate. It's in a gross rollable environment. It's providing with supplementary pension provision, and it can be invested in the ways that we've seen. Okay, thank you. I think we'll take a pause there if we can. I've seen some questions building up in the Q&A. So John's going to help me with the questions, and John will come in now. So if we can bring the questions up, we'll start to answer those. We've answered some of the questions that you asked prior to the webinar as we've gone along. So we'll just see what's in this Q&A.
Yeah, some of the questions that were posed during the slides, Dave, you've answered as well. So I've identified those ones to the people who posed those questions. So yeah, John, if you want to collate any that you've already had in advance.
Yeah, no, I think David's gone through most of the questions that he had in advance as he's talked through the presentation. So I'll just start with the first question that came through from Philip. He's asked if QNUPS, if we know how QNUPS are taxed in Spain. for Spanish residents. Is wealth tax applied, and is it taxed as income or savings tax? So yeah, I think we know from experience with Spanish residents that if pensions are structured correctly, overseas pensions, it is possible to have them paid. And I say if structured correctly, it might be that a contract-based QNUPS rather than a trust-based QNUPS is used. It should be possible to have income paid and treated as savings tax rather than income tax, and it will be preferential for Spanish residents to have it paid in that way. I believe, again from experience, from research that we've done previously, that money within overseas pensions within QNUPS isn't subject to Spanish wealth tax. That is something that we would be looking to clarify with the technical support that we offer to financial advisors, that we would be able to advise on that, and perhaps bring in Spanish tax advisors for additional comfort and support if necessary.
Yeah, thanks, John. Yeah, one of the things that I didn't go through when I was talking about how QB partners support advisors is that we've got a lot of experience within the business. We've got 8 consultants within the business who have worked in financial services for a long time. Our background is UK centric, but we have developed a lot of research and development capability in terms of overseas jurisdictions, and that's supported by a network of tax advisors that we have in different jurisdictions. So, these questions from Philip and Liam are absolutely relevant. You need to consider the HMRC position on this, but you also need to consider very much the position in the country of residence. And we have some familiarity with certain jurisdictions. As John says, we have some familiarity with Spain, but in other jurisdictions we will take local tax advice, and we have a panel of tax advisors that we work with in many jurisdictions where we can get that tax advice. And the advantages of working with ourselves is that we can often get the tax advice at a lower price than you might get if you go directly, because we can go to them with our report and say, this is what we think from our research. Is that correct? Can you fill in the gaps, rather than going with a blank sheet of paper? And also from your perspective, often I find financial advisors are nervous of bringing tax advisors in, because the tax advisor then might say to the client, well, this is tax advice, it's not financial advice. And working with ourselves, we would only bring in the tax advisor when absolutely necessary, and it's controlled by ourselves. So there's some protection for your relationship with the client from that perspective.
Yeah,
Okay.
I'd reiterate that. We've worked together on some complex tax questions for clients previously. So some of these might not be a quick yes/no answer. They might require further analysis, and that's where you guys at QB Partners can ask the right questions to make sure that you get to the ultimate answer that's required. So yeah, anything along those lines, we can work together, and advisors do already approach us on that basis. So that's a service that we're able to offer to all.
That's it. Yeah, that's what I mentioned at the beginning. Actually, if you go to Novia Global with your technical questions, Paul's very modest, but he's got a good technical background himself, so he may be able to answer the questions, and some of his team may be able to answer the questions. But if it's one-off questions like this, Paul will come to us, get the answer, and come back to you. And that's one of the advantages you get from working with Novia Global, who outsource technical support to ourselves. Okay, some of the other questions. 50% of GAD as a percentage. So GAD is a government actuarial department guidelines on the calculation of pension income. And basically what it does is look at the client's current age, looks at the age that the client's likely to retire, and looks at mortality rates to find a life expectancy, and then works out what level of income might be provided by the fund over retirement. And then that's 100% of GAD and government actuarial department guidelines. So 50% of GAD would be half of that, basically, obviously. So that's how that's worked out broadly, Liam. Okay, should we look at some of the other questions? There's some more questions coming up. David Marks, whose firm works with us, we know. John, do you want to pick that up? David's question?
So if normal pension rules apply, then after assuming they've taken PCLS, money comes out of the QNUPS, full income tax would apply. So that's right. If we're looking at UK residents, then when they take pension income from a QNUPS, it is taxed in the UK. So this part of the planning, part of the considerations involved in considering QNUPS is the IHT savings, weighing that up against the other tax implications, including what income tax will apply in the country that the client is resident. So that's absolutely right, David. You would need to consider that, and you would need to weigh up what the income tax position is versus the savings on inheritance tax, or the potential savings on inheritance tax.
Okay. Thanks, John. Thanks, David, for the question. Anonymous attendee, how is QNUPS viewed by non-UK tax authorities? To be honest, it depends on the tax authority. As I say, we would obtain local tax advice, and with this planning, we always recommend chartered tax advice to support the planning, as well as the actuarial report in terms of the belt and braces approach. So it does depend on the tax authority, but through the experience that we have, we know, for example, where contract-based is better than trust-based, because the tax authorities might look through trust-based, and we know some of the tax treatment in different jurisdictions, and the most common jurisdictions for expatriates, but there are lots of jurisdictions out there. Patrick's question, hopefully we've covered that. We believe that the wealth tax is deferred, but we would take a local tax advice in Spain to confirm that, John, wouldn't we?
Yeah, we have had tax advice in the past on QROPS and QNUPS for Spanish residents that we could refer to clarify that understanding. But it is normally on a case-by-case basis that we would seek to provide clarification and take tax advice if necessary.
Okay. A QNUPS suitable for US residents? Good question, Alan. Yeah, US is obviously one of the most complex jurisdictions from a tax perspective, and also from a regulatory perspective. Very litigious area. I don't know. Yeah, I think if you have a double tax treaty between the QNUPS jurisdiction and the US, then you would be able to pay income gross into the US. We'd have to use a QNUPS provider who was familiar with US reporting. It would have to be an investment platform that was familiar with US reporting. But I think if all of that was in place, then we could have QNUPS planning for a US resident.
Yeah, and Malta is a popular jurisdiction for QROPS in particular, and there are also QNUPS available in Malta, and there are a number of US pension schemes in Malta that have been set up and designed to receive pension money for US residents. So there are solutions available for US residents. I think you'd still need to look at the client's circumstances. If it's a UK domiciled US resident and they needed supplementary pension provision, then yeah, I think QNUPS could be and perhaps should be considered for the client.
Okay, next question. Garrett's asking, can an offshore bond be used underneath the QNUPS? I mean, we'd say that from an IHC point of view, the QNUPS takes the benefit out of the client's estate anyway, takes the contribution out of the client's estate anyway. But yeah, the bonds can provide the 5% tax deferred income. So the bond is held by the QNUPS. The income goes back into the QNUPS, and then the QNUPS pays out to the client. So does it benefit from the tax deferred income?
Yeah, my understanding is that the QNUPS would be the owner of the bond, and therefore any tax benefits of holding a bond would largely be removed. It perhaps could be used as a platform or wrapper to hold the funds, or if you've got an existing bond, it may be possible to move those into a QNUPS. But I understand that the 5% tax deferred income wouldn't apply if it's held within a QNUPS.
Okay. Is Mike Fox
Yeah,
all over?
I'm here if you can hear me. Yeah, I totally agree, John. The QNUPS would normally wrap around an offshore bond, possibly later on, further down the use of the structure. But certainly once it's in the QNUPS, the 5% deferred income doesn't work.
Yeah.
Okay, thanks. Okay, there's questions coming in thick and fast. Paul, it's 45 minutes now. We're happy to stay on a bit longer and finish off these questions for the people who've asked the questions.
Yeah, I think that's fine. We've still got most of the participants logged in, so I think there's keen interest in these. So we crack on.
Yeah, we'll carry on then. Okay. Can a UK property be included in the QNUPS? Can it be held by QNUPS? Sorry, non-UK property. Yes, it can. Again, you need to be aware of the commerciality and motive rules that we talked about. So the motive of the QNUPS is pension planning first and foremost, and the property would have to be held on a commercial basis. So, you know, I used the example of a holiday home. If you had a holiday home that the client was using and enjoying, then that probably wouldn't be permissible. But if it's non-UK residential property, then there's no reason why that can't be held by a QNUPS or commercial.
It would be at the discretion of the QNUPS provider, but we've worked with QNUPS providers that have solutions that they're able to hold property within them. So yeah, I think that would be possible.
Okay. Liam again, what are QB's charges to clients and advisors? So you can perhaps contact us separately about that in terms of the detail, but we provide our support to the advisor. We can facilitate tax advice to the clients directly, but when we provide support to an advisor, we charge on a time cost basis at £200 per hour. And then we have, for this type of planning, for example, we have fixed fee suitability reports, so we can produce a report for £750 for QNUPS planning, or £1,000 to include due diligence on the recommended provider. Okay, Mark Smith, hello. If a client has set up a QNUPS and was then to reside in the UK, never made a withdrawal, surely HMRC will see this as tax avoidance? Yes, Mark, I agree. So it has to be genuine pension provision. You have to take an income, and we gave the guideline as 50% of government actuarial department. It's the minimum level of income that should be taken as some time. I think most trustees, certainly by age 75, they'd be saying you need to start taking an income from this structure. But it doesn't have to be taken from 55, but we'd recommend that at some point that you start taking an income. And if you don't take any income, then it could well be seen as HT avoidance. Some of this is quite subjective, and that's the view that's come from the tax advisors as well. So there's no somebody mentioned sort of grey area before. There's no sort of set black and white rules. I think if HMRC did that, they'd be making it too easy for us. But what they do say is that that it has to be genuine pension revision. That has to be the motive of establishing the QNUPS. And so what we've implemented over a long time, we're working with experts and tax advisors in this area, is we've implemented something which shows that the pension is being, the QNUPS is being set up as genuine pension provision, and documents that on the file.
Most QNUPS providers will insist that the client takes an income from age 75 at the latest. So yeah, if they die after age 75, then they most likely will have made a withdrawal, because they'll have been made to by the provider. And when setting up the QNUPS, a lot of the QNUPS providers will insist on UK tax advice, or will ask for, if the client is taking UK tax advice to support the planning. And for the providers that insist on this, we work closely with UK tax advisors to facilitate that. And tax advice supplements the suitability reports that we prepare for the financial advisors, and we produce that as a package, which together provides evidence that it is for genuine pension provision, that it is being done to, and it does satisfy the correct QNUPS rules, the commerciality and motive clauses of the QNUPS rules.
Okay, thanks, John, and thanks, Mark, for the question. Liam, the UK domicile rules, that's probably a separate presentation. Actually, we did have some slides that we were going to get onto if we had time, but I don't think we'd have time to go through that now. It may be something that Paul and Steve want to consider us doing as a separate presentation in the future. We'd be very happy to do that, or you can speak to us after this presentation about that. So
yeah, we can pick that up separately.
Apologies for skipping that one, but it's quite a complex area if we're getting into any detail with it. Patrick McDonald, Spanish tax authority doesn't recognise PCLS. Yeah, that's true. But what we normally say with pension transfers is take the PCLS when the client's still in the UK. Will they allow proportional tax relief on lump sum withdrawals, i.e. only tax the gain element? Not sure, John. Do you know the answer to that?
No. So yeah, with the PCLS, yeah, it's UK pension, UK residents. We say take the PCLS before you move to Spain, because it is taxed in Spain. With QNUPS, PCLS is available, but that doesn't have to be taken. But yeah, when taking lump sum or income to Spain, I think we've got experience, and we work with Spanish tax advisors, so we can research that and yeah, make sure that it is tax efficient for the client.
Okay.
But yeah, I don't know the answer to that specific question.
So that's something, Patrick, where we would have to involve one of our tax advisors to check that point. But it's a good point. Thank you. I think Tim, you're helping us with a statement rather than the question. I think that's absolutely true of any jurisdiction, really. But Tim's saying that given the schemes available in the US, you'd have to justify recommending a non-US product that wouldn't be tax relieved on contributions, and that's the same in the UK. Actually, we do say use your UK pension allowances. So if somebody has UK pension allowances, if they're UK resident, if they're US resident and have US pension allowances, use your local tax relief pension allowances first, and indeed, other tax beneficial schemes such as ISAs first before you consider QNUPS. So thanks, Tim. That's a good point. Sean, would a QNUPS in Malta be preferable to a QNUPS in the Channel Islands? Yeah, it does depend on the underlying members' country of tax residence, very much so. So we mentioned a couple of jurisdictions where Malta have double tax treaties. So Malta have double tax treaties with all of the European jurisdictions. And what that means is when income comes to be paid, they can pay. Malta trustees can normally pay the income gross, and it's taxed in the local jurisdiction, so it makes the taxation simpler. There are QNUPS available in the Channel Islands, and the Channel Islands QNUPS tend to be sort of quite flexible in what they will allow. Sometimes need to be a little bit careful they're not too flexible, and that they therefore don't go beyond the realms of genuine pension provision. So for example, the 40EE plans in the Channel Islands, they could meet some of the QNUPS requirements with HMRC, but if they start providing flexibility in terms of when money can be drawn out, then that might not be seen as genuine pension provision. So yeah, we'd look at each client's circumstances, each client's objectives, and recommend the most suitable jurisdiction for the QNUPS planning. A couple more Spanish questions. We did expect lots of Spanish-based advisors on the call today, so that's probably not surprising. So Teresa says, can a Spaniard, so a Spanish national with a QNUPS draw his 1 million as £100,000 run over 10 years under the lower savings rate versus income tax rates, as you mentioned? John, I think you did mention that. Is that your understanding? So
yeah, and
keeping it under the threshold so that it can be savings rate taxed is Teresa's question, I think.
yeah, I understand that using the correct scheme and taking correct level of income, then it can be taxed at that lowest savings tax rate versus income tax rates. But that is something that we would need to look into further and perhaps discuss with one of the Spanish tax advisors that we worked with previously.
Mm. Yeah, okay, and the best location for his QNUPS?
Yeah, so we mentioned Malta QNUPS, we've mentioned Isle of Man QNUPS, we mentioned Guernsey QNUPS. We'd be looking to use a QNUPS solution for a Spanish resident that, first of all, allows gross payment of income. So if you look at UK pensions, when the client comes to take an income, it may be that withholding tax would apply in the UK. So you want to identify a QNUPS jurisdiction that either has a double tax agreement with Spain or where the client is resident, or that doesn't rely on double tax agreements to pay income gross, such as Guernsey. Guernsey can pay income gross as long as the client isn't a Guernsey resident. Malta has a double tax agreement, so we'd be looking at those jurisdictions. We'd be looking at the other circumstances, the investment preferences and objectives to identify a solution that works in a jurisdiction that's compatible. So yeah, short answer, there's a couple of options.
By the way, that Spanish person is never returning to the UK. Thanks to me. Yeah, John's question, is UK residential property above 500,000 not subject to ATED and dwelling taxation and nice new taxation that was introduced by HMRC 5 or 6 years ago? Yes, probably. Just to be clear on the case study, we weren't necessarily saying put the residential property into the QNUPS, place the residential property into the QNUPS. We were saying that client could make an investment from his assets. He had cash as well. He had other assets. So not necessarily a property. And yes, you're right, John. You'd have to consider all the different tax implications before it was implemented. And then I think the last question on here from Richard, which is, oh, right, thanks, John. John's going because it's 11 o'clock. Richard, this is the same thread, John, about the sort of Spanish tax treatment, cost of CGT, Spanish resident. So, it ties into Teresa's question, I think, doesn't it, about the tax treatment there. Any thoughts on that?
So yeah, we're drawing from QNUPS plus to CGT. How would this be when his income from a pension? Thank you. Yeah, this is something that we've worked with Spanish tax advisors to identify the correct pension solutions and ensure that it is taxed at the most preferential rate. And it's something that we've also worked with pension providers on to make sure that they understand the tax position when paying income to Spanish residents. So yeah, it's our understanding based on the work we've done previously that it is taxed as savings income when the correct solution is used. But yeah, we would need to work with you further to provide reasons why that is.
Great stuff. Well, thanks a lot for all the questions there. As you can see, quite wide ranging and quite complex. So it's great to be able to have access to guidance from experts like QB partners. And certainly going forwards, if there are any more questions or queries, we'll be able to liaise with the guys on them for you. That just leaves me to say thank you for attending the webinar today. And thanks to Mike, John and David from QB Partners for all your expertise. There will be a recording available of today's webinar. So if you just want to recap something yourself personally, or if you've got any colleagues who you feel might benefit from a review of the session, by all means, when that becomes available later, you'll be able to share that with them. And yeah, look out for our next webinar invite. We're working on the subject as we speak. So that will be landing in your inbox very shortly. So just leaves me to say thanks once again for your attendance today, and look forward to seeing you all soon. Thank you.
Thank you. Thanks, Paul.
Thank you.
Thanks, everyone.